thanks for joining us. I want to thank Aaron for all his hard work in producing, and that it's still in works, to be honest with you. We haven't finished this document. I haven't written the last chapter yet. I've done all the study. If you looked at the pile of work that's been handed Aaron over the past 2 weeks, it's probably about 2 inches thick per chapter, stuff I've read to try and draw conclusions from. I can't assume that people that are listening have ever heard one of the reports. I'm going to just give you a little bit of history on why I attempted this and really why it's become a passion, and it's kind of become what we've been known for. In 1989 and 90, we were experiencing a boom that just felt just like 2005. Very powerful price swing happened between 85 and 89, and I had a project in Palm Springs that I continued too far into 1990, and it didn't do well at all, costing me about 2.5 years of grief as I wrote checks and tried to get rid of real estate. In 1995, Aaron graduated from high school, and I bought him a Honda Civic for $15,700, and 2 days later bought a 3-bedroom house in Riverside for $13,300. And that occurrence scared me because I thought, okay, well, what happened in '89? What happened in California that real estate went from it's great to no one wants it? I looked up in the archives of news articles from 1970 to 95. Any article written about price movement in California, I read it, whether it was in a magazine or a newspaper, and I was trying to figure out, somebody must have written about long-term trends in price movement in California, but I could never find it. So in June of 95, I decided to take the project on to see if I could figure out why prices move in California and if there were warning signs as to when it ends and when it starts. If you could figure that out, it would be one heck of a cheat sheet for a California investor. And so that's what this series has been about. In January of 97, I finished the report called The California Comeback. And in that document, we predicted prices would double in 8 years. And we'll take a look at a chart to see how that worked out. In 2005, toward the end of '05, we wrote a report called The California Crash and predicted that prices could crash by a very large percentage and foreclosures would go up thousands of percent. And that's what we've been living through for a long time. As a speaker, the period of time between '06, '07, and say 2011 has been really difficult because there's really not been much I could say in a positive way going forward. And so I've really tried to, I can't tell you how happy it is to have a document say California Comeback 2 on the cover, because it's a fun seminar to give, and we're really going to have a very large price increase in record speed would be my projection. Again, I haven't written the last chapter yet because it's in that chapter that I tell you where I think it's going to end. The title, though, has a dangerous word in there, and that's unusual for a comeback document. But this comeback is different. We'll talk about that as we go through some of the charts. And this cover is clever in the sense that you've got a hot rod that's going at breakneck speed, but maybe will not be able to make the curve safely. And so the tire is already showing some smoke. There's no barrier other than somebody's experience to make it around the curve. When we went up in prices in 2005 and we got to a point where I thought it was over, I'm very happy we sold all of the properties we wanted to. A lot of people did not. Somewhere down the road, we're going to have that same decision. And that decision is going to have to be made by statistics, not by emotion. Because at the time you're in the middle of this next boom, you're going to be very happy you own stuff. The problem is that this price boom could end on a dime. And we'll talk a little bit about why that could happen. And that is a little unusual. And not only could it could end so fast that there's no way I'll be able to produce another document in time to tell you it's coming. So here's a document saying this boom is here and we're going to enjoy it, and oh, by the way, here's a warning label, and it's already got the exit plan for you in the last chapter. This series of reports that we've written, including the crash and Category 5 tip of the iceberg, none of it's possible without Aaron's ability. I read all the stuff and I put down my thoughts, and he pulls it together and makes a document that just is lights out. So just thanks to Aaron, and thanks for all the people that have followed our reports. And I imagine the audience will be very filled with people that have come to these before, and it's just exciting to have something very positive to say that I know we're all going to do very well in the next couple of years. The next, the chart that you're looking at now is a history of the median price starting in 1990. So at the end of '89, when prices really started to falter as far as not going up, there's a lot of damage that can happen even in a market that's as benign as this one. We had not a big price drop, as you can see, but still, if you had a project that you built that you shouldn't have built, you paid for it very dearly. So the median price didn't go down very much, and it was pretty mild compared to what we just experienced, but it was still painful to get it wrong. I wrote the report called California Comeback in the beginning of '97, and as you can see, it was pretty accurately timed, and an 8-year projection took us up to 2005, where we really experienced a very large increase. And one of the things I want you to see is that that increase gradually got stronger and stronger, but in the beginning, it was kind of tepid as well. You went from 177 to 186. If you look at that percentage-wise, it's no big deal. Same with the next year. Same with the next year. It's not so much until you get all the way to 2000, and then it starts to crank. That's what's different about this time. This time we are off and running very, very fast. And so you've got to be careful to, first of all, you don't want to disbelieve that this is happening. It's happening, and it's going to get stronger. Normally, these increases in price typically build on lots of things. As inventory goes down, as emotions toward real estate get hotter and so forth, all that builds over time. We're basically starting, instead of like a marathon run, we're in a 100-yard dash. So prices are escalating at a pace we haven't had before, and for reasons we haven't had before too. And that's what makes these reports kind of fun to do. As soon as you think you're sure of something, they change the rules, and you have to study a whole different set of circumstance. Aaron, go to the next chart, and we'll take a look at the median price that's happened after 2005. This is the chart as it peaked. In 2005 to 2007, we had a median price increase of approximately $100,000, and probably none of that should have occurred. All of that occurred because of the financing. We're all very familiar with the things that allowed that to happen, stated income loans and all of that. Well, we paid a big price for it. As prices dropped, they dropped like never before. They literally crashed. They're going from almost 600 to below 250. And so that's the market that we've been experiencing, and then experiencing the aftermath of that. One of the things that happens is that when you're an investor, your mind is skewed by when you started. So if you started anytime after July of '07, you've known real estate to do nothing but cause some problems. And you haven't experienced prices escalating at a pace that makes you just very excited that everything you touch is going to make money. Well, that started to happen in the last year. And once again, this is a very different comeback. From a year ago to now, we have prices increase in California, the median price from 312 to 402, a 28% increase. There's never been a price increase run that started with a year that powerful. It's just never happened before. Part of the reason is we went below replacement cost on our downturn, but part of the reason is also legitimate for other reasons, and we'll take a look at those charts as we go forward. Next chart, Aaron. What we're going to take a look at is the affordability chart. And one more chart, Aaron. There's a number of elements in affordability. There's how much you make in income, how interest rates change, and how prices rise or drop. So this is the history of affordability. This was one of the charts that I realized was a very important chart. If you take a look at 1980, 81, 1989, 90, 2006, 7, whenever this affordability number hits a bottom and goes back up, that's a big problem for the marketplace. This is what the report is really, one of the things that we're going to do is say, okay, we're likely going to have an ending that is recognizable. And what you don't want to do is you don't want to be caught short. You don't want to be holding inventory the year that chart changes directions, because that causes a lot of problems. And one of the things it causes is a reaction to how many units are sold. So the goal of this report will be to accurately pick the ending and do it in a way that we haven't ever attempted. We're not going to pick a price, but we're going to pick a monthly payment per area. And it's going to be recognizing that interest rates might be changing very strongly. So we're going to really rely on that combination of things. What happened to income, what happened to interest rates, what happened to prices, and then really give you a wide swath of saying this is how you could get to this monthly payment. The higher interest rates go, definitely the less price you'll be able to attain. One of the things that happened that never happened before is in 2006 and 7, we dipped below where we normally end. So it was repetitive. In 1980, we got to 17% affordability. In 1989, the same thing. In 2005, the same thing. And that would have been where I would have said it's over. Well, it wasn't over as far as price increases. We went up very high in price in 06, 07. The affordability skewed way below. And so when you're in the prediction business, you have to go back and look at your methodology and say, okay, was I wrong, or did something occur there that had never happened before? And we know that that was true. We allowed people to buy that shouldn't have bought. Going forward, I wouldn't count on this chart going below 17. As a matter of fact, I really have to give consideration to maybe the lender's policies now, instead of being so lax, might be so restrictive that you never get to 17% affordability. It might stop at something higher because it doesn't let enough people in. All of that is, math I've got to figure out. But this chart is very important. One of the things that I know happens, if you start at, say, 1998 and then follow to 2005, you start at 40% affordability and go all the way down to 17. That journey down in affordability allows for the price increases to happen, for interest rate hikes to come if they will. But what occurs is during that price increase and that affordability decline, people get more and more and more excited about real estate. Right now, our affordability is at 44% higher than anything we had in the 90s. And what I'm going to tell you is that we literally have all of the room in monthly payment that we had from 1998 to 2005 still left going forward. That's kind of an astonishing statement. We went up enormously in price between 98 and 2005. Could we duplicate that? If you just look at this chart, you'd have to say, yeah, you could. Now, we're going to have an interruption in that because of interest rate hikes. But anybody thinking we have a bubble is telling me that you think our price run is going to end at 40-some% affordability, when before, when we've had that, it allowed us to go from 44 to 17 and have a tremendous price increase. I am not afraid in the least of the future until this number gets way, way lower than it is. And the way it gets lower is you have price increases or interest rate hikes. And my bet would be that we're going to have mostly price hikes instead of interest rate hikes for a lot of the duration of this going back down. So this is why this is an exciting time for us. We're going to, a lot of us already own real estate. It's going to escalate. A lot of us are going to tie up real estate now or land, and we're going to get really well rewarded for our efforts. The dangerous part is we better get out in time. This is going to be no joke of an ending, that's for sure. So I don't want to have any of us looking at, okay, we own property and that affordability chart went the other way. Not this time, because I think that would be very, very painful. Aaron, go to the next chart, and we'll talk a little bit about a chapter that we haven't ever done before, the Fed and the history of interest rates. One of the things I realized is how material it's been that the Fed has participated in lowering the rates, and they stayed there for a very long time. We look at a chart here, and this is Fed fund rates all the way from 1970. I got in the business in 1980-81. The interest rates were 16%, and now they're virtually zero. One of the things that I had to figure out was, okay, when the Fed decides to pick a new direction, how mild are the changes and how often do they come? And we have a chapter, it's all about that. I'll just give you a clue that when the Fed decides to change directions, it's not always mild and it's not always slow. We're going to come off of a bottom that we've never been at before in my lifetime. And I would imagine that the increases going up will be more severe and more quick than we've ever had before. And now I'm going to tell you that the most changes in a year for the Fed has been 21 interest rate changes in 1 year. Can you imagine tomorrow the Fed starting to say, okay, we're going to start shifting into a normal interest rate environment, and we're going to start changing interest rates, and they literally do it every 17 days? You'd be in escrow, and your interest rates probably would change for your borrower twice inside of each escrow. That's a very significant chart. We do not want to have this chart end our price boom without knowing that could happen. So this is real important to understand why the Fed changes their rates. So I literally have looked over the history of their Fed funds rate and why the changes were made. That's very important to understand. And it doesn't have anything to do with real estate. It has to do with the economy and so forth. That's why we have chapters about the national economy. Inventory levels, we are at really very low levels once again for this stage of a price boom. If you take a look at the levels that we had in California in 1997, when we just started to escalate in price, we had reached a level for single families that was about 6 months. We had come off inventory that was level of about 13 months, and we gradually came down. This time we got up to a pretty high number in 2007, and as we all know, we artificially improved until we're now down to below 3 months, 2.8 months. That level is usually reserved for years like 2002, 3, 4, where we had enormous price increases. Now, one of the fears are for people that, okay, now that we've gotten down to this inventory level, what's going to happen is these prices are going to escalate, give everybody equity, and they're going to dump all their inventory in the MLS, and we're going to have this chart spike upwards. Well, what I like about charts is you look at it and say, okay, well, is that what happened last time? Show me a chart that shows that inventory was spiked going way up while you've had price increases. I don't see it. So you're either going to have the same thing happen before, or you're going to have to set history. My bet is you're going to do the same thing as you had before. We're at levels right now that are mimicking like between 2001, 2002, and the only way they went up is when we priced ourselves out. So I literally think that we're stuck with this inventory level. And one of the things that we'll take a look at, why unsold inventory levels change, I think we'll find that it's not just how many properties show up for sale, it's how many properties go unsold. Right now, you don't have properties go unsold, and you didn't have them in that unsold in 2002, 3, and 4 either. So we're going to have a very difficult time going up in inventory from 2 months, 2.8 months to another big number. It's just, I don't see that occurring. And so this is a very important chart going forward. Aaron, go ahead and change. Also, the mix of inventory is important. As prices go up, this shadow inventory concept you know, where the inventory that could damage price, the lender-owned stuff, the huge amount of inventory that people still think it. The banks own it. They're hiding it. They're not bringing it out. This chapter will show you that's really fallacy. All these people that were way behind, that haven't been foreclosed on, that's still a reality. But when you have price increases clipping along at 28%, they become equity owners pretty fast. So shadow inventory, we're not going to spend a lot of time on that because it's not the elephant in the room anymore. But we'll get rid of it to where we can go, okay, whatever is for sale is going to increasingly be by who owns the property. The foreclosure ratios and why it's still dangerous. And Aaron, do we have a chart on the foreclosures? What we see in 2008 and 9 and 10 all the way through the end of 2012 is trustee sales declining. That occurred while defaults were increasing, people not making their payments, and existing sales have gotten better. But what this chart isn't showing, but what we'll show in the seminar is that we still have a lot of people in the default stage, and the policies that allow this inventory not to show up in the MLFs have been very important. Let's don't foreclose on people. So it's one of the problems with this prediction is that it really is having to say, okay, are the policies that are in place going to continue? Or a price is going to be so aggressive that it doesn't matter. You can foreclose on people now because when it gets to the trustee sale, they'll have equity and it won't matter. Somebody there will buy it. So trustee sales, when we look at the statistics, I think you'll be surprised that the default rate is still really historically high, way high, for any normal period. It just feels better than where we were. So this is a little bit of concern if somebody says, you know what, we're now going to treat foreclosures as normal. You could have, if you didn't have price increases, this could be an issue. We also have trustee sales to sales ratios that are returning to numbers. If you take a look at, you're now back to 1994, 95 levels. We artificially got there, but we're on the way down. And the direction for foreclosures is usually very significant. When you start foreclosures down, trustee sales down, it usually goes and goes and goes until it disappears, like 04, 05. That's the chart we're going to experience. By the time you're in 14 and 15, that chart will probably be so low that there won't be very many motivated sellers. There will be, you know, we'll start even forgetting the definition of a short sale and an REO. It seems unlikely, but honestly that happens. So this chart is significant because the mix of sales in 2008 were so heavily REO that it completely crushed the price, a ratio that we've never even come close to before. And it's been gradually declining. Now it's back to a year that's still not, normally we wouldn't think of positive, 93.45, but because the direction change is different, we definitely aren't going to have this chart cause us problems in the future until it changes. Next chart. Fannie, Freddie, and FHA are literally the financing. Aaron, go to the chart that shows the credit. I'm just going to point out that FHA's program, this is the one announcement that would make me very concerned about anything that I'm saying about prediction, and I don't think it's going to happen. But FHA, they're already loaning to a very different group of people. In 2007, 45% of their loans were made to FICO scores less than 619. 2011 and 12, it was 3%. So they've already really reined in their qualification process, but what they haven't reined in is the amount of loan that they'll make. In Riverside, they'll make a $500,000 loan, and when we were at this median price before, they would make a $160,000 loan. So the loan balance is triple what it used to be. That's a very big deal. If the FHA reverts to their former formula, and this is what this chapter is going to do, is show you historical ratios between Fannie and loan limits and FHA loan limits in each of those areas, because if they go back to historical ratios, this would change the game. you'd have an FHA loan limit that would be way below Fannie's limit. The problem is that these people that lost their credit can't get a Fannie or Freddie loan. They have to get an FHA loan, and if they can only get a 160 grand loan in Riverside, our median price is going to have a big problem. So this is a very important policy decision going forward. In October, we have at the Nixon Library, we have somebody from the Mortgage Bankers Association, and Dodd-Frank is still has an uncertain ending. We don't really know what's going to come down the pike. I do know that lenders right now are putting in overlays as if Dodd-Frank is going to occur because they don't want to buy back loans. So that becoming an uncertainty, you've got lenders already reining in loans that they were making in, let's say, February that they might not make in July. That's another game changer. So this finance world is important. Fannie and Freddie have a mandate to do less and less and less volume, and they're trying to get rid of 5% of their portfolio a year. So this is the one major concern, but they are going to find out that the loans that they wrote in 2011 and 12 were the safest they've ever written and the most profitable. Fannie just came out with a huge profit. So this is an important chapter. We'll also take a look at, there's a report that shows what loans were not approved. What was the FICO score? What was the debt ratio? So you can really see the barrier is very tight. And you can see that it's really never been this tight before. What do I think is going to happen? I think we'll probably have relaxed standards going forward where we're going to loan to more people and at a more reasonable FICO score. Doesn't have to be quite so high. That dance usually happens along with price increases, and we're probably going to do it again. Aaron, next chapter. Employment, normally the first domino that falls for a California comeback is this, and this time it didn't happen. We've got one anyway, so employment doesn't matter this time. The answer is no, it doesn't. Is it going to be an accelerant? Absolutely, but we already started a comeback without it. Because the comeback is going to be in place, you're going to start having contractors add employment, and that's going to help other factors in California. So we're going to take a look at where the unemployment occurred and how quickly it will resolve itself once construction gets back into business, which is really starting to happen right now. This chart of unemployment shows that you've got unemployment in the United States higher than California. California higher than the United States. When those two connect, get closer, you end up having lots of migration. So if you look at the chart from, let's say, 02 to 06 and look at a migration chart in a county like Riverside and San Bernardino, it's very positive during those stretches. That's about to reoccur as those lines get closer. Next chart, Aaron. The construction business, it's been very dormant. I know that the home construction feels like it's really improving. It is coming off of the bottom. This is for California single family. We're somewhere around 28,000, coming off of years that are been bouncing around between 21 and 25. That chart's going to change. It's definitely going to start spiking upwards. Our biggest challenge is the next chart, which will show the subdivisions. So as far as our price aggression, we're going to probably buy predominantly existing real estate. One of the concerns might be, well, is all this inventory going to come from the builders? It doesn't look like once they get done with building on their existing lots, they're going to have an enormous inventory of building lots to build on. 2008 through 2012, 5 years, very few subdivisions, way below par. And they're going to start creating subdivisions, but they haven't yet. 2013, in the first quarter, I just took a look at that data. Riverside County, this is Riverside County's in the brown. created 5 subdivisions in the first quarter of 2013. So if you thought, well, they really must be excited now, they're not as excited as you think. In LA, 200 subdivisions is typical, and I don't know what size they are, but in the first quarter of 2013, 1 subdivision was created in LA. So this is a category where you're going to have a group of people very surprised at the aggression of price increases that are going to make their lots pencil. So you're going to see lots of subdivisions. I just hope they get them done before the price ends. My guess is that they don't. They won't because they never have. Next category, Aaron. When I speak at the clubs, we've talked about this, and go to the next one, Aaron, as far as the counties that have all the people that were foreclosed on reemerging as buyers. And the report expands this to lots of different counties, so we can see the ratio in Orange County and Sacramento County and San Diego County. No matter what the county is, this is Riverside, we have an unprecedented number in brown that were foreclosed on in 08 and 09, and the gold line is just the number of sales that took place in 2011. And why this is significant is that you've got a big, gigantic group of people foreclosed on in 08 and 09 that 3 years later can buy using an FHA loan, and they'll save money if they do so monthly. That is unprecedented. And even the numbers 2010, 22,000 people foreclosed on, 37,000 sales. That represents something like 60% of a year. Those people want to buy, again, they're landing on top of normal demand. The group from 2008 and 9, I'm not buying that they've been satisfied. Every realtor that I know has clients that want to buy, live in a house, they can't find them a thing. So this big group of people keeps moving forward and landing on inventory that's half of normal. And in some counties, it's way below normal. San Bernardino is even more exacerbated. So when we take a look at all the counties, what you'll find is that each of them have an unprecedented number of people that were foreclosed on waiting to be buyers again. That's going to have a significant impact on the aggression of the price increase, and that's why that chapter is important. I'll be brief here. We appraise properties. Rick Solis has done appraisal for us on a number of properties. There's about 20 properties, different counties, different square footages and ages. I think we appraised them in 05. We appraised them again in 2010. We're appraising them again now just to see what's changed and what level are we looking at now. One of the things that happens is during a price, well, anytime, they participate in forming public opinion. Aaron, go to the next chart, please, or the next picture. In 2005, this was probably not the well-timed picture, but it told you how you felt about what you owned. I believe this was in 2005. And if you look at the comfort level that this guy feels, this is exactly how people felt in 05 and 06. Owning a piece of real estate was comforting. You could hug it and it would spit money out. It was a second job. It gave you a cushion for your life. And a few years later, Time Magazine has a cover saying real estate, as far as home ownership, maybe we should rethink home ownership and not even do it anymore. And what was funny is that maybe home ownership is no longer economically feasible when it was half of the price that this at the time this cover was. So here it was wonderful to own, and then half at half price and lower interest rates, it's economically unfeasible. That's how they can shift people's opinion. What's about to happen is every article for the next few years is going to be very positive about real estate, and it does help people make decisions. And that's about to happen again. Next chart, Aaron. Commercial real estate. Let's take a look at, is commercial real estate in the same position that residential real estate is? And the truth is it's not. And what this chart is showing is that you've got debt maturities. And if you take a look at 2013, happens to be the highest year, not by much, but you have the highest amount of debt coming due in 2013 that has to get paid off renegotiated, or sold. And the next 2 years are also high. Actually, the next 4 years are high. We're really residential buy-sell people, but it might not make you might not be making a mistake to take a look at commercial real estate, because price aggression for that product will be a lot less in the next couple of years probably than residential real estate. So it might be something to take a look at. Next category, Aaron. Foreign demand. One of the things that we would naturally think of is that as prices increase, people from foreign countries would buy less real estate, and it's exactly the opposite. So this chart shows the progression of interest in real estate, and overall in 05 they were buying a whole lot more of it than they were in 02. And the reason this chart is here is that going forward you're going to have a group of people leave the buying of residential real estate called hedge funds, and we're going to come up to that in the next chapter. But when they leave the party, there's a concern that when they stop buying, there's going to be now a glut of inventory. What happens over the years when they quit is that this group will step up. And in the chapter on hedge funds, Aaron, go ahead and go to that chapter. It's just a title page. This is a very important category we've never dealt with before, and the report is going to have a separate chapter, and it's going to basically be able to show how much these hedge funds have bought. Sean O'Toole has provided us the data. It would cost a fortune if I had to buy the data. Fortunately, he already does that, so him giving it to us is a real important thing. These hedge fund buyers have participated. We're going to basically be able to break down what percentage of California real estate are they buying. Some people think it's 20%, and maybe in some pockets it is high. But I think this chapter will give you something to look at and say, okay, this ratio, at least now I understand what they buy, where they've bought it. If they all sold in the same month, which is very unlikely, what damage would be caused. So this is a chapter that will really give us an idea. If these hedge funds as a group are market makers when they leave, will they be a game changer? So will we get caught short? Oh boy, all the hedge funds are selling. I should have sold before them. I think you'll feel better when you see the numbers that maybe they're not as influential as you think. But this is important subject to get behind us. California owner's equity position. Again, Sean O'Toole has provided us information. And this is an important transition going from last year we had this data in the last report that we wrote, and this year an improved equity position. And so as investors, we take a look at this and say, okay, places where you have large negative equity positions that are going to be emerging as positive are great subject to areas. Areas that you have very small negative equity positions, those are good areas, let's say in Orange County, where you might buy a property and expand it and add a bedroom. The more you have price increases, this equity position, of course, becomes more and more positive. I think you'll also be surprised to see the amount of properties that are owned free and clear in California, and the amount of properties that have equity that is in excess of 20% is increased a lot. So this transition has really started to take place, and it's important for us to recognize that. This chapter that we're looking at now, the budget problems with California, and this has to do with basically we underperformed and we dropped off so much that we're trying to play catch up. And what this chart is saying is that we would need an 8% growth to get back to trend line, and we wouldn't get there until 2019. I think what's going to happen in California over the next couple of years is we're going to get surprised at the aggressiveness that real estate helps the budget get back to more normal. And I'm not saying we solved our long-term problems as far as retirement dollars and all that, but I think that what we've gone through in the last 2 or 3 years, talking about this chapter, we've always talked about, California's got this huge budget deficit, $15 billion to $40 billion, and, it becomes just almost unsolvable, and all of a sudden it's probably going to be, you're probably going to have budgets that are positive for the next couple of years. And I know they play all kinds of games. We will talk about that in this chapter. It's the games that states play to hide negative deficits. And California's got a lot of it. And there's a book that I'm about to read that talks about California's debt that's coming up as far as retirement. The U.S. debt may be more pertinent in the sense that it'll dictate perhaps what happens to real estate. So we've got a very big deficit. They're going to try and find places to gain income. They've already done that. They've been surprised this year. They've had to revamp their budget as they have collected more revenue than they thought. Some of that was from last year, where people sold some things not wanting to pay higher taxes in 2013. But people are also making more money, and the things that create capital gains are significantly improving. So real estate's going to be a driver for tax revenue as people sell properties and make money again. This budget deficit, though, if you take a longer look, so the short term it's improving, the longer look is what we have to be concerned about. This report's talking about the next couple of years. The budget deficit's going to decline. We're going to have aggressive price increases. We're going to have sales that are going to add to the tax revenue more than people think. That's what that chapter deals with, but it also deals with the longer term period and what we as investors will probably need to do. This chapter is a really exciting chapter, and really I wanted this chapter right before the prediction chapter because this is going to be a juggernaut of surprise. The household growth and migration been very dormant and even negative for California. We've had very flat migration. We've had domestic negative migration. The only place we've had any positive has been immigration. Household growth has been very stagnant, behind trend. All of that's about to change. What happens when you have a gigantic recession is that you have household growth decline. You have people move in together that normally wouldn't. You have people stay at home longer than they would normally. You have people put off marriage, put off kids, put off purchases of homes, etc. Well, that's all about to change, and California real estate is going to be a big benefactor. You don't have to have so much migration when people are going to come out of the bedroom and say, I'd like to live on my own again. You're going to have migration anyway. So that's what's going to start occurring is California is going to have a very positive time. It's really going to be, this chapter is going to show that this is the perfect storm, that we have all of these households that have been sort of pent up, waiting to be created, are going to land in the next few years and create demand for our product. What product is going to be for sale? Not a lot, and it's going to drive price very hard. And that's why this next 2 years is just really important for our industry. We have a chance to make a lot of money in a short period of time. I would be very surprised if we have less aggressive price growth in the next 2 years than we have this year. So you're going to have stacked, very aggressive years, and we'll figure all that in the math in this chapter, calculating the next peak. It's not a chapter that I've written yet because I haven't seen all the charts. So literally, I have to wait to see all the charts. I've learned something this time in looking at all this. There's a whole other category of warning that I didn't know existed, and that'll be in this chapter. So we'll probably have 5 different categories of charts now where we can say, okay, if we're looking for proof that this thing is over, here's the 5 categories. And we've tried to refine the affordability one, not just to an affordability number of 17 for the state. We've actually taken a look at every area and looked at what we think the peak price should have been in the past, not 07 or 06, but 05, calculated a monthly payment, and then go forward and say, okay, what's the payment going to be in the future? Where's the breaking point? So I have to figure out all that. What's the future earning potential? What's the interest rate? What's the price? Doing that for each area, I think, is smart, because what's going to happen is you're going to see that some areas will peter out before other areas. So you might be able to shift money. You might have a boom that could happen on the coast, and then the money gets shifted to an area that's underperforming, and then it will catch up. That also can happen in product type. So we'll talk about how condos really accelerate toward the end of a cycle. All of this is going to be, in my opinion, still, it's going to be fast-forwarded. Last time we had a boom that lasted 8 years. Are we going to have a boom that lasts 8 years this time? I would be shocked. I really would be. So I feel comfortable saying that this document is long enough for us to enjoy one heck of a price increase. But 8 years from now, I'll have to tell you, if we're still going up in price, something went wrong. I just want to be a participant in the next 2 years, and I want you guys to as well. What's important about this document is that it will contain a lot of very lengthy charts and categories that matter. So to get this data all in one spot, to me, is very important. I look at these documents myself in making decisions all the time. So if this is the first time you have a chance to get one of these documents that we've written, that's one of the best things you'll have, is you'll have a history of these categories. I've just been very lucky that people that have this data have let me look at their archives. Calipoli, Pomona, Michael Carney Dr. Carney has been very generous. He has reports that go all the way back to the 60s, and it's really allowed me to nail some categories that I wouldn't have been otherwise able to do. And he has one copy of each of these going back several decades, and so I'm in the archives, and I'm the only person that's usually allowed in there besides himself. So just that type of access has allowed me to draw better conclusions. The last chapter is wild cards. There's things that can happen outside of real estate or inside of real estate that can be game changers, and we'll spend a little time on this, not a lot, but you just have to be aware that the real estate industry is definitely not a standalone world, that there can be other things that happen that throw off all the predictions, and they're game changers. So right now, I think we have about 130 people that have already committed to go on July 13th. It's my intention to give this one time. Last Saturday we had 420 people, and I don't think there's any doubt we'll have that many for this, and I think that's about what we can have. I think we can have about 450. This is probably, it's got to be close to one of the last reports I'm going to be writing. I don't know if we're going to have too many more in this series, because I think this price run-up is going to be significant and fast, and we're going to have an ending in the last chapter. Don't be afraid of that dangerous part for the short term, though. That affordability number is still way up there. Interest rates going up. We've had a 0.5% interest rate hike in just the last month, and it did exactly what I thought it would do. It didn't hurt interest as far as people wanting to buy properties. It made them come off the sidelines. Aaron, do we have some questions?
Not yet. I've been answering them as they've been coming in, but haven't had any yet. And we've got about 10 minutes if anybody wants to. Oh, hang on just a second.
Okay.
Oh, what do you think the bottom? What do you think the bottom? Again, will this be the answer? I'm not sure I understand the question, Brad.
Okay. What were some of the questions that you fielded? What was the gist of them?
They're asking very specific questions about specific areas, and I let them know that would be in the report, and that you probably wouldn't know that offhand.
Okay.
When do you think the time will be to get out?
Yeah. What's nice about, I know that that's a repetitive question. It's not a time frame. It is literally a series of charts that tell you. What if it happens 18 months from now? It means that you would have had the most ridiculous price run ever, but getting out in time will be even more important. If it takes 4 years to get there, then you would have still one heck of a price run. It just spread out over more time. Don't get hung up on time. Realize that it's a function of math. When does this stuff hit a breaking point? it's repetitive. And you want to sell while people are still happy about real estate. One of the things this report is not going to encourage you to do is get every last dime of profit out of every property. That's how you lose what you earned, in the next couple of years. That's the easiest way to to lose it is to hold on to it too long.
Do you think the buy and hold would be a good idea in this market, fast and furious?
Oh, absolutely. This is what we live for, to have everything we touch go up 28% in a year. With leverage, that's a ridiculous return. And so people that bought a year ago when we taught the seminar, some people that we know have over 50 houses that have gone up a lot. They've made millions of dollars sitting there owning stuff that they've already bought. So yes, that's why on Saturday when we taught the seminar, subject twos and lots and so forth, all of those will have big profit centers for people that participate.
Will you explain quickly what the difference is between what we did last weekend, how to make $1 million in 24 months, and California Come Back 2?
Yeah, completely different intent. This document has nothing to do with how to be a buy-sell investor, where the other seminar, it was trying to tell you what activities to do as an investor to find properties so you can benefit. This is an economic projection. This is saying, okay, these are the charts that mean something. It's very specific to California. So this isn't, somebody always asks me, well, would this be true in Nevada or Phoenix? The answer is no, because all of my expertise is in California. And honestly, we decided to do that because we wanted to be so specific to our state. So this document has historical significance. It's been right at the turns every time. So whatever we're saying does matter. But we also realize that federal policy has something to do with where we're at right now. We're going to tell you the warning signs and say, okay, if the Fed changes their policy, if the lenders change their policy, if Dodd-Frank is fully implemented, all of these are game changers that will affect what happens. And so, I got to be honest with you, it's a document that I would pay a lot of money to have on my shelf.
We got a lot of questions coming in now, so in only about 7 minutes, so we'll try to fly through some. After Quadrant 4 is over, will your next report be called California Armageddon? But it goes into another question. You said this would be the last report you would write. You just meant before you think that the market's really going to turn, you might not have time to write another report?
That's a good question. I think it's true, to be honest with you. I think that are you still there?
Yeah, I'm here.
I'm sorry, it changed stuff. Yeah, I honestly don't believe I'll have an opportunity to write a report, because I think we're going to, whenever the changes are made in interest rate, I think it'll be such a significant change that we could be what we think is a very safe affordability number, and we could have that change to a very dangerous one so fast that you and I couldn't put a document together. Will I write another report after that? I probably will, if I think there's some value. To be honest with you, these reports, I love them to death, but they're a lot of work, and it's. Will I do it again? You're asking me at the wrong time. I'm exhausted from doing this one. But yeah, there'll probably be another reason, another reason to do it, to see what's next.
Do you expect irresponsible lending practices to return?
I don't expect them to get as crazy as they were, and that'll be part of why I think the ending will be more normal than crazy. I don't think we'll be able to say, you guys forgot all about the subprime stuff, right? So we can sell you the same bonds we did before. I don't think that's true. So I think our affordability chart will probably be more significant. Again, depending on lending policies, it may not even get down to 17 before they pull the plug.
Do you see big differences between Northern and Southern California, and you're going to cover Northern California?
Yeah, we are going to cover Northern California. We're not going to, I don't think we're going to give one this year, but we are covering as much or even more of Northern California than we did in the last report. There aren't only differences between Northern and Southern California. There's differences in counties in Northern California and Northern California. There's, look at San Jose, San Francisco, and look at Sacramento, and the progression that the two expensive areas have had making their way back up to the peak price, and then look at Sacramento. Well, Southern California has the same thing. And so that's one of the things we recognize, that it really isn't, it's really not accurate enough to say 17% affordability. It's to say that San Jose probably has got this much price per month that it can feel safe that the prices going up to that level are okay. After that, it's pretty much nonsense. And see, that's really the point, is that you may have price aggression past what's reasonable, but that doesn't mean you're not going to give it back. And that's what a smart investor does, is realize that it's all of the sensible upside is over. Now it's completely a speculation after that. That's what you don't want to do.
Okay. You said that the next 2 years will be great to buy properties regarding single family and condo. Which one would you prefer for the next 2 years?
I think either would be fine. Condos usually have a lot more upside toward the end because they're not the desired inventory. So if you asked an audience of 1,000 people, how many of you guys like to live in a condo versus a house, in 2013 that would be, maybe 85-15. If you ask that in 2005, I bet it would be much closer to what people were willing to say yes to. So that transition about what they'll buy occurs as Quadrant 4 gets more mature. Manufactured homes become okay, condos become okay, because they can't afford a single-family home, and they rationalize that the other product is just like a house.
Okay. Will the impact of the compact have as much time reaching all areas of California? Orange County is obvious, but will less desirable areas benefit as well?
Yeah, absolutely, because once again, when you say less desirable, you almost in the same sentence is, oh, that's where we're going to build new houses. So Lancaster, Palmdale, Victorville, Rosamond, all those areas where we think, okay, well, they got hammered. Well, they got hammered in the 90s somewhat, but we were able to build again. So I think, yeah, you're going to have those areas come back, and maybe because, you have to get to a point where it pencils to build before the builder can even start. They're not going to provide inventory for quite a while in those areas. I remember Rosamond, we bought the lots in 02, and it didn't pencil to build until 04. So it can be pretty late in the game for some of those areas, but they can experience really aggressive price growth. When Tony Alvarez and I met in 04, he was ready to sell what he had, and one of the reasons why I knew that was a mistake is I was paying attention to the same area because I was dragging my feet to start a project when he was about to sell everything he had. I knew prices hadn't finished going up because new homes didn't even pencil. So that's going to happen again, would be my guess.
Whew. Okay, I'm trying to answer as many that I can. What will make hedge funds exit? And yeah, let's just go with that one first.
Hedge funds will exit. Some of them already have. Carrington just left the house buying business. They'll leave when they think the cap rate doesn't make sense. The rents aren't going to give them sufficient cap rate. So I would say they're leaving as we speak.
Do you see high-end properties having the same run-up?
I'm sorry, do I see what?
High-end properties, coastal regions, different price categories.
That'll all come in the last chapter, where I really take a look at where we got to, where we are, and where I think we're going. My gut feeling is typically prices accelerate from the coast in. It's been typical. And so I would say that they've probably experienced um, a fair amount of growth already, but again, I haven't put a pencil to it yet.
Once we make all the gains from this run-up, what's the game plan for the money? That's a Disneyland question, I guess.
Yeah,
Can we expect a crash again, and if so, how hard relative to the most recent one?
that's probably the most significant question. And that's what that last chapter will be forced to deal with, is to say, okay, if we price ourselves out to this monthly payment per month on the backs of price increases while interest rates stay with the 3%, my bet would be you would have a crash worse than one we just experienced, because it's just math. If somebody is going to end up paying a 6%, have a 6% mortgage rate at some point in the future, and you've pegged yourself all the way to the end of affordability at 3.5, you've got a very big problem. That's really the challenge, is that this country is going to do less well than California. California is going to be just ripping through and having great price increases and having a very different environment than the nation for a while. It's how long that while continues, and if the goals of the Fed are reached where they can say, okay, well, now we can raise rates. Unemployment is sufficiently improved, so we can go ahead and raise rates, and GDP growth is okay. Right now on the horizon, it doesn't look like that's going to be this year, that's for sure.
Rentals. If we start going down, do you care if you own rentals?
I do care if I own rentals in areas that I wouldn't want to take the decline. That's a good question, and I know everybody would have a different answer, and the answer about where to put your money is a really good one. If I write a report that follows this one in a couple years, and if we're close to the end, let's say, of price, it really have to deal with real estate again, saying it depends. If California pegs itself to unaffordability on the backs of 3.5% mortgage, and if I think interest rates are going to now make a 30-year journey back up to 10% or something, or more, it's again math. I have to look at it and say, well, how much aggression in price could there be if we're going to have the headwinds of interest rates going up? We're very spoiled. Interest rates, when I got in the business, were 17.5% fixed, and they gradually, they've played some bumps along the way, but now they're 3 3/4 or something down, up from where they were. That's almost a fifth. That's crazy. So my interest rate was 5 times as high. No one here has ever experienced the interest rate chart going the other way. So you have to think, won't that be a headwind to price? So I would really have to do the math and see. But I'll be honest with you, owning a rental without a price increase isn't that exciting.
Will the interest rate continue to go up if the Fed stops buying bonds?
I would say that would be definitely a yes. Do I think that that's going to end what we're experiencing right now? Not at all. You'll end up having people realize that they've missed the boat and they want to get on the boat before it completely leaves, and they'll be very aggressive at trying to buy. Long term, it's healthier if they stop buying it, to be honest with you, and we get a higher interest rate.
He mentioned he doesn't expect affordability to get down to 17% before the turnaround, and how the mortgage payment will be more the focus. Can he expand on that?
Well, again, I didn't say I'm going to consider that if the policies of lending are still restrictive, then there's a chance we might not get to our former lows in affordability. So what we're going to do is we're going to calculate a monthly payment breaking point for each area. So I'm not going to look so much at the affordability in the future. I'm going to look at the monthly payment breaking point for each area. I think it'll approximate the same thing, but again, there's a lot of math ahead of me where I'm pretty much going to go into a secluded place for a couple of days and with my calculator and figure all this stuff out.
Is a price increase of 20% year over year still reasonable given the increases that have already taken place?
Just take a look at the affordability chart. You're at 44% right now, and before the price boom in, let's say, starting in 97 to 2005, you had 40% affordability. You literally have all the room in affordability that you had from 98 to 2005 unspent in our current boom. So I think you can answer your own question. It's just math.
Raw land. Somebody's asking if to stay away from raw land.
You know, I'm not going to tell you to stay away from it. People that know how to do raw land make a fortune on it during booms. What I don't want to hear is that you got caught with it. 3 years from now, you're in the middle of rating your lots, and you started the process of, you know, getting it all approved and going through the process with the city, and you didn't make it till you got hammered by the end of a price boom. So if you're going to play in dirt, you want to make sure you're out before they ring the bell. That's all I can say. People make fortunes in quadrant 4 in dirt. I mean, this is probably the most volatile upside there is in real estate. Unfortunately, it's also the most volatile down. So if you didn't get out of this dirt before the price boom ends, you could be tied up for a long time. So be careful.
All right. Unfortunately, we just have so many questions, and we've already gone over by about 10 minutes, and everybody's been hanging out really well. So let's wrap it up. And if there's any other questions, you can email me to at Aaron, Aaron, at thenorrisgroup.com. And I'm hoping to have this presentation up by the end of the day on the registration page for the event. And with that, we should probably get out of here.
Okay, guys, thanks a lot for listening, and please come to July. You'll have a lot of fun.